So the authors in this paper want to understand how common anomalies that have been found in the prior investment literature are affected by each other whenever they're combined. So, for instance, the five anomalies that they're studying are the size anomaly, which this is market equity, the value anomaly, which is the book to price ratio, profitability anomaly, which is this is the return on assets, the investment anomaly, which would be companies that whose assets increase the fastest, and then momentum, uh, which is based on the past 6-month returns, so winners versus losers. And so here they first look at the returns for each of these different factors, and by splitting them up into quintiles, with the lowest ME, so these would be the smallest companies, to the highest ME, which would be the largest companies, to see how does the return change based on um, the size of these companies. And the same thing happens for each of the other factors, where low book to price would be representative of a growth company, high book to price as a value company, and then high profitability versus low profitability, high investment versus low investment, and high momentum, which would be past winners, versus low momentum. So a lot of these returns for each of these different factor levels is in line with the prior research. For instance, smaller companies tend to outperform larger companies. Value companies tend to outperform growth companies. More profitable companies tend to outperform less profitable companies, although we sort of have a U shape here. Companies with lower investment rates tend to outperform companies with higher investment rates, and past winners tend to outperform past losers. So what the authors have done additionally here is they've got each of these five quintiles of the level of this factor, but they also split each of these quintiles into another variable. Well, actually, what we have here is the coefficient for each of these factors in this portfolio quintile. For example, it shows the sensitivity to size. For instance, we might say that the larger companies have, well, the value effect is less prominent in larger companies than it is in smaller companies. Also, the larger a company is, the more profitable it tends to be, and the less investment it has, or that its asset growth rate is. But momentum seems to be indifferent as far as the size of the companies. And then going down to the section about value, we see that the larger companies tend to be growth companies, and they also tend to be much more value or much more profitable. They invest a lot more, and they tend to have higher momentum. So next we can look at the profitability in relation to the secondary statistics. Here, as we found earlier, larger companies tend to be more profitable. And also looks like the least profitable companies tend to be value companies, which makes sense. And also, the more profitable companies tend to, it looks like, invest more into the company, so increase their assets. And the momentum seems to have a U shape, so it's somewhat indifferent as far as the profitability of the companies. So next we have investment, where here we have companies that purchase more assets, or their assets grow faster than these companies on the low side. We see that the level of investment is somewhat indifferent to the size of the companies, but we do see that value companies tend to invest less, purchase less assets. The more profitable companies tend to have high investment rates as well, and momentum again seems to be inconclusive. And then the last one, momentum, we have here past losers and past winners. And as we found in the prior discussions, there's somewhat of an indifference as far as how each of these factors relates to momentum for most of them, except the value criteria. And this makes sense with prior literature, because prior literature says that, or shows that momentum companies tend to be growth companies. So in this case, we have past losers tend to have the highest book to price ratio, which is indicative of value companies. So we say that the higher momentum companies tend to be growth companies here.